How does a government fix a recession? Now we'll talk about debt too. Fiscal policy is when Congress, via taxation and spending, enters into the macroeconomy to help stabilize it. It can be used to get actual GDP closer to what the economy's potential. Of course, they're not the only institution we have for macroeconomic stability. We need to take into account and coordinate it with monetary policy. The economy is full of business cycles. The unemployment rate goes up and down. The government can be a force to help mitigate this. Sometimes we want the goal of boosting output during a recession, and sometimes we have the goal of reducing output, say if inflation is too high and the economy is too hot. To boost output, we need higher spending. To reduce output, you need lower spending. And on the taxes side, boosting output means lower taxes. And on the reducing output side, I bet you can guess it, we need to increase taxes. This is the whole story right here. More output means more spending, less taxes. Slowing down the economy means less spending and higher taxes. Now, it's not just a switch. The government just can't come along and turn the economy on and off. First, policymakers need to recognize that there's a need. We need to know we're in a recession. Collecting macroeconomic data takes time. And then after we know, Congress has to get together with the president and they have to formulate a plan. What's the best way to craft some legislation to help improve the economy? And then, even after they sign the plan, they have to write the checks. They have to spend the money. They have to hire the people. They have to do the project. Those things also take time. It can be years after a spending bill has been passed that the money is finally spent. All of these lags along the way are challenges to the government entering the macroeconomy and improving it, reducing a recession. There are some lessons we've learned along the way of what makes good fiscal policy to reduce a recession. Number one, it needs to be timely. It needs to be quick. We saw this during COVID. Immediately in March and in April, the government wrote checks and gave them directly to people right in their direct deposit checkings account. It was timely, it was quick. They set up lending institutions very quickly for the Paycheck Protection Program so that businesses can go to the government and get grants to help support their workers. Second, we like it to be targeted. That means it goes to the people who need it and not to people who don't need it. This is a question of efficiency. Can we help solve the economy for the least amount of money? Sometimes there's a trade-off between these two, and we saw this trade-off during COVID. When they gave checks to everybody, they weren't worried about being targeted, but they were worried about being timely. What's the challenge of targeted? You need a bureaucracy. You need people to fill out forms. You need to check documents. All of that takes time and effort and can slow things down and not be timely. You have to balance these two needs. And finally, it needs to be temporary. Stimulus is not a permanent program. Stimulus is expensive. It's only needed when the economy is in trouble. When the economy gets better, the stimulus needs to go away. One of the best forms of stimulus is unemployment insurance. It does all three of these things excellently. It's timely. As soon as you're unemployed, you go to the office, you get it. There's already a bureaucracy set up. And because there's a bureaucracy set up, it's very easy to target it. It goes only to the people unemployed. That's the people who need it. It's also temporary. Unemployment insurance doesn't last. It expires. You can only have it for so long. The generous unemployment insurance we saw during COVID alleviated a tremendous amount of suffering without causing the negative distortions that sometimes excess government spending can do. Unemployment insurance is a type of automatic stabilizer. These are spending and taxation programs that adjust automatically and there's no need for new legislation. This follows some of the best practices for fiscal policy. You don't have to write any new bills. You don't have to assess the situation. The program already automatically adjusts to changes in the macroeconomy without even relying on gathering new data and judging where we are and where we're going. Another one is a progressive income tax. If your income falls, you pay less taxes. If your income improves, you pay more taxes. It automatically adjusts according to the macroeconomy. Now, government spending isn't free, and I don't mean just it raises taxes, but more government involvement in the economy comes with trade-offs that we must take into account in our cost benefit. One example is the crowding out effect. This crowds out investment. Here we've got the market for loanable funds that we've learned in previous chapters. The vertical axis is the real interest rate, and the horizontal axis is the quantity of loanable funds, and here we have a market equilibrium. When the government runs a deficit, or particularly if it increases its deficit, it acts as a borrower. It's borrowing money from the economy in order to pay for its spending. This decreases the supply of available loanable funds for private investment. It will shift the supply curve up. That leads to a new equilibrium real interest rate, which is higher than before. And when the real interest rate is higher, less projects are profitable and the demand for loanable funds will decline. The public debt crowds out the private debt, and in the end we can get less private investment, and that can harm long-run growth. But I have to emphasize this is more of a problem for the long run. During a short-run crisis, the private sector is not investing because they're worried. There's a lot of uncertainty. The economy is not doing well. Again, another lesson that good stimulus must be temporary to help avoid any crowding out effects. Now let's compare fiscal versus monetary policy. Monetary policy carried out by the Federal Reserve and fiscal policy carried out by the Congress, House of Representatives, Senate, and the President. Monetary policy is more nimble. You just get the Board of Governors together and they can immediately change the interest rate overnight. The downside is it's one interest rate for the whole economy. It's not as targeted as fiscal policy can be. Congress can get together and write a bill to give the spending or give the tax break only to the people who need it. It can be more targeted and solve the macroeconomic crisis more efficiently. Additionally, fiscal policy is important when the interest rates get down to zero, because when your interest rates are near zero, there's not much more monetary policy can do. That's where fiscal policy can come in, increase spending, lower taxes, targeted towards the people who need it, and help improve the macroeconomy.